The battle over whether high yield is in bubble territory rages on. Here to offer his opinion on the matter is Tim Gramatovich, co-manager of the Peritus High Yield ETF. Welcome, Tim. And tell me, bubble or not?
Bubble, but in loans, not bonds. And as you said, it's misplaced from the standpoint of being a bubble. It certainly isn't in high yield. I've been at this 28 years now. But one could definitely argue that there is a bubble developing in loans as the dry powder from the CLO issuance is there, and we're seeing some dumb things being done.
All right, let's talk about your ETF. There's not a lot of dumb things being done there because you yield around, let's say, 8.3% versus the JNK, which is the index ETF, which yields a little bit less than 7%. How do you do it?
I think there's a real misnomer in the high yield market, especially with JNK and HYG. The restrictions that those funds put on themselves really, they're not an index fund. They're not representative of the high yield indexes because they have a 600 million and a 400 million in terms of issuance restriction. The 400 million has to actually have $1 billion of outstanding debt. So they really are accessing 25 to 30% of the true high yield market. So when we hear that there's no yield in high yield, we kind of chuckle because there's plenty of yield in high yield.
Is there capital appreciation left? Because your fund's up around 2%. The JNK is flat. Now you're actively managed. So why don't you talk about that as well as how fees get involved?
Right. And you and I had an opportunity to discuss this the last time through. And there are two things that sort of jump out at us in terms of capital gains. If you're an investor in the high yield marketplace, think of it as a call premium and think of it as a poison put or a change of control covenant. So what we mean by that is that bonds can be refinanced. When bonds get refinanced, they're refinanced at a premium. So in essence, if I'm buying bonds at 100, perhaps their first call date is 105. And same thing, if a company is acquired, then we are able to put the bonds back through a poison put or a change of control covenant, typically at 101. So if we're buying those bonds at a discount to those prices, we're generating gains on top of it.
All right, you're talking about calls, but usually when people look at high yield, they talk about default rates. Right now, they're pretty low. Do you expect that to move up, or does the fact that there's so much cash sloshing around the system mean we're going to put that off for a while?
Right. Yeah, I think it's going to be a couple of years. But I think that it's important. It's not so much the cash; it's the source and uses. Right. So the issue is that what we've had an incredible issuance the last couple of years. Record issuance last year, somewhat $360 billion. And really for us, it's a use of proceeds. Is to say, what were you doing with that money? Were you spending money on dividends? Were you playing games? Was there shenanigans? And for the most part, it was really refinancing. So we just don't have a lot of maturities coming due in the next couple of years. And the use of proceeds just doesn't lend us to see that there's a big default rate coming here.
So you actively choose the bonds in your portfolio as opposed to some of the other ETFs and funds out there. So where are you seeing the best values now?
Right. A very eclectic approach right now. We are thematic. We've been thematic investors, and we look and we say what industry groups might be out of favor for the wrong reasons, et cetera. Nothing jumps out at us from that. Energy and energy services certainly is an area this year that we think will bottom. I think there'll be some opportunities there. But really, it's a bond by bond approach. And I think for us, we're looking to put 60 to 70 names in that portfolio. What we're looking to do is we're value investors. I mean, basically, at the end of the day, we're looking for loans, bonds. Purchasing a bond is really making a loan to a company that can pay us back. How they pay us back is through free cash flow generation, and free cash flow to us is absolutely paramount.
All right, thanks a lot, Tim.
Great, thank you very much for having me.
And thank you for watching The Street.